If you can't read a candlestick chart, you can't trade. Candlesticks show you who's in control, buyers or sellers, and where price is likely to move next. Today, I'm going to show you exactly how candlesticks work in the simplest way possible, so you can start reading charts with confidence in 2026. A candlestick is just a visual way to show what price did during a specific time period. That's it. Every candle shows 4 key pieces of information. Open, where price started; close, where price ended; high, the highest price reached; low, the lowest price reached. If the candle closed higher than it opened, it's usually green or white. If it closed lower than it opened, it's red or black. Candles tell a story, and understanding that story is the foundation of trading. A candle has 2 main parts. 1, the body. This is the thick part of the candle. It shows the distance between the opening and closing prices. Big body equals strong momentum. Small body equals weak momentum or indecision. 2, the wicks, shadows. These are the thin lines above and below the body. They show the extremes of price during that time. Wicks tell you where buyers push price up, where sellers push price down, where reversals often begin. Once you learn to interpret bodies and wicks, you can read price action like a language. Candlesticks appear on any time frame: 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly. For beginners, here's the rule. Shorter time frames equals more noise. Longer time frames equals more clarity. Day traders typically use 1 minute for entries, 5 minute for setups, 15 minute for trend direction. Swing traders use 1 hour, 4 hour, daily. Choosing a time frame is not about being right, it's about matching your style. Candlesticks are not random shapes. They are a direct reflection of market psychology. Long green candles equals buyers in control. Long red candles equals sellers dominating. Long upper wick equals buyers tried to push price up but failed. Long lower wick equals sellers tried to push price down but failed. Small body plus long wicks equals indecision, tug of war. The candle isn't just a visual, it's a fight between buyers and sellers, and your job as a trader is to figure out who's winning. You don't need to memorize 50 patterns, you only need 3. 1. Bullish engulfing, a strong green candle completely covers the previous red candle. This signals buyers taking control. 2. Bearish engulfing, a red candle overtakes a previous green candle. This signals sellers taking control. 3rd doji, indecision, small body, long wicks. No one is in control. Often appears before big moves. These 3 patterns alone give you 80% of what you need to understand candlestick behavior. Candlesticks help you time your entries, set your stop loss more accurately, spot trend reversals, understand volatility, avoid emotional decisions. Before using indicators, before drawing Fibonacci levels, before building a strategy, you must know how to read candlesticks. Everything else is built on this foundation. Here's what I want you to do today. Open Trading View. Switch to a 5-minute chart. Watch the current candle form. Guess whether the candle will close green or red. Don't trade. Just observe. Do this for 10 minutes a day. In 1 week, your understanding of market behavior will be 10 times stronger. Now that you know how to read candles, it's time to learn the technical analysis basics that actually matter. Not the fancy indicators, not the complicated setups. I'm talking about the 4 concepts that every professional trader uses, no exceptions. Support, resistance, trend lines, volume. That's next. Click on the next video in the series. Technical analysis basics you must know. Forget indicators. This is where the charts finally start making sense. I'll see you there.